I'm Charlotte McLeod with investingnews.com, and here today with me is Rhona O'Connell. She is head of market analysis for EMEA and Asia at StoneX. Thank you so much for being here. Great to have you.
Great pleasure, Charlotte. Lovely to be with you.
Yes, really good to be speaking with you today. And where I think it makes sense to start is with the gold price. We saw it go below 4,000 this week, and for some investors, that's causing a little bit of concern. So I wonder if you can break down the factors behind that downward move in gold.
Well, when it's been as high as 5.5, 3,980, or actually no, we're just above 4,000 now. That's a big fall, and I can understand why some people are perhaps scratching their heads. I think most of us have been doing that from time to time. But I think to explain why it's come down as far as it had, and there's a myriad of elements that all combine to form this huge equation. But I think to start off with, what we need to do is to look back to the turn of the year and January, because gold was obviously rising on geopolitical concerns over the course of 2025. And even if we go back as far as 2024, there were some institutional investors who had been waiting for a $200 or $300 drop so that they could get in. And in the end, they had to capitulate because the market was smarter than they were. So people eventually just piled in, sort of accepted matters. But around about, it's hard to pinpoint exactly, but I would say around about end of November, start of December, gold started going parabolic upwards. And that was being driven increasingly by algos, commodity timing advisors, stops being hit or limit orders or whatever. So it became very, very crowded, too crowded, frankly, and topped out at sort of 5,500 and change, I think it was, on the 29th of January. It came down with a bump. And there were two reasons behind that, and we probably want to explore the second one a little bit later. The first one was that it was just overdone, way overdone, and something had to give. And when it started coming down, there would, by definition, have been weak-handed holders in there, or speculators who'd got stop-loss orders, and so on and so forth. But the second element there is that it comes from outside the gold market, and that was the meltdown in the equities. And one of the things which I think does tend to confuse people who don't watch the market all the time, which is what I'm paid to do. I'll do it so you don't have to. More often than not, I think I ran a chart this morning for a quarterly that we're putting out. And if you go back only as far as 2023, you can actually spot on the chart there have been 4 occasions, of which last January, early February was one, when the equity markets are having a tough time and gold comes down as well. So the question that I and my peer group have to parry on a regular basis is, if it's a safe haven, why isn't it going up when everything else is in trouble? And the answer is, it's because it's an insurance policy. It's all the usual, trot out all the old lines. It's the one asset which is no one else's liability, or at least the one currency that is no one else's liability, because it's international and it's not issued by a specific central bank. It's very liquid. It's actually quite a lot larger than some people might think it is. It was 3,700 tons of mine production against 25 million odd tons of alley. Well, what's that? Nothing. But when you put a valuation on what 3,700 tons is worth, and then the LBMA numbers show that just in spot activity, forget the forwards or options or anything for the time being, typically, and I write this up every month, so I've got a running tally on the numbers. Spot activity, Loco London, over a course of 12 months, is anything between 65 and 85 times 12-month mine production. And then when you gross up Loco London into global, and we think it's about 80% of total, that gives you over 100 times mine production in any 12-month period. So it is deep. So what happens, time and again, I've seen it so many times, is that people who've got gold in their portfolio as a risk mitigator, as opposed to looking for capital appreciation, because that's two completely different arguments, will use it as an insurance policy, because not only does it push the efficient frontier in terms of performance, but because it's liquid, and this actually goes back historically to the days when most equity markets settled in T+3, whereas now they're pretty much all T+2, they will sell some gold to generate cash to meet margin calls if necessary. And we have talked to family offices and high net worth and professional investors about this frequently, and almost invariably will find that those who have held gold and have sold it in times of distress, they'll always buy it back. So they re-established their position. So that's why it came down as hard and as fast as it did in early January, February. Then, of course, we saw Iran, and we didn't quite know what was happening there. And for quite a long time, nobody really wanted to trade. And the prop traders weren't doing very much, and I don't think the institutional investors were doing very much either. And then eventually, when it started looking as if this thing was going to be protected, the gold itself turned away from geopolitics per se and started looking at everything through the prism of rising interest rates. And that's been the most recent factor to keep it under pressure.
Well, let's get into that a little bit. I think there's a lot to say about what could be going on with interest rates. A lot of focus still right now among investors on last week's Fed meeting, which of course we saw rates stay steady, but it was the first meeting with Kevin Warsh at the helm. And I think everybody's trying to read behind the lines, or between the lines rather, on his comments. So anything that you would pull out there that could help us understand what the Fed's path forward might be?
I'll do my best. It probably won't be very much. I was at an excellent half-yearly conference held by Pantheon Macroeconomics yesterday. And one of the questions from the floor is pretty much what you've just asked. And the chap who covers the US for Pantheon said that in his view, at any rate, Kevin Warsh did a very good job of saying nothing for an hour in his press conference. He didn't suggest that he was ducking issues at all, but he just thought that what Warsh is doing, he's only been in post for 3 weeks, maybe 4. It's his first FOMC meeting. He's got to gauge the temperature or the attitudes of all the other FOMC members, because it's important to remember that it is a committee, it's not a kingdom. So they don't necessarily have to have unanimous consensus, if that's not tautology, but he needs to know what he's working with. Also, we've still got geopolitical issues in the background, so I can't imagine that he would have wanted to specify anything on an individual basis last week. The act of putting together 5 task forces, I don't think is playing for time. I think it's actually doing proper research and getting a handle on things. Because don't forget, he's got a high reputation both as an academic and as an experienced banker. So he's not just going to go in there with all guns firing. So the impression that, well, what we've got at StoneX, our chief strategist, who's based in the States, she is looking for 125-point hike at the end of the year, or in fourth quarter. Which I think is pretty much consensus, although now some people are looking at 2. But then by the same token, the chap at Pantheon yesterday was saying he could probably make a case for possibly a hike in the fourth quarter and then starting to ease in 27 as the inflationary elements pass through, assuming they do, of course. So I haven't given you very much clarity on that because there isn't very much clarity to deliver, I'm afraid. I think it's just a question. He's doing his job properly. He's not going to go at it like a bull at a gate. And he equally, the labour market is okay. It's inflation that they're concerned about. And he's not going to want to throw things off balance too quickly.
Well, and inflation is certainly another tricky one. I'll ask you about it, but I do understand it's tricky to be able to say anything about it right now. I know we had some concerning numbers earlier in the month. I believe today, I think we got the PCE price index data, which is, of course, the Fed's preferred gauge. So anything that you can say about inflation moving forward as well?
I'm surprised. Well, I'm not surprised that it's because of what I've just said about it being Kevin Warsh's first meeting. But I have been surprised for the last 12 months at least that the Fed has maintained that 2% target. So I'm not an economist, but I talk to a few and I read quite a lot. And a lot of people seem to think that 2% is just not feasible anymore, particularly with the resilience of the US economy at the moment. Although one of the points that was made yesterday was that part of the US resilience, in their view, is because we've had all those income tax credits coming through and people have been spending them. And that's going to fade away. So that element of inflation is probably going to ease slightly. What we don't know, of course, we're going back to the Middle East here, is the extent to which oil prices, they've unwound all those gains. Doesn't mean to say they're not going to put them back on again. If there's a problem. We really are casting about in the dark on that one for the time being. So if you're a professional investor, then you don't necessarily want to use gold as your primary inflation hedge. That should be the TIPS index. the Treasury inflation protected securities. Historically, gold's had a reputation for being a hedge against inflation. But because we've got so much more of a sophisticated financial system now, its role is much more important as a mitigator of risk. And as I said, pushing the efficient frontier, which if anyone hasn't come across that is by adding a little bit of gold, obviously at your own discretion as to how much. Then if you think of a Cartesian chart and you've got the curve of risk against reward, adding a little bit of gold will either raise the reward for the same level of risk, or for the same level of reward, you'll reduce risk. And that's one of the major reasons why professional investors use it.
There tends to be, I think, and I'm guilty of this as well in the gold market, a tendency to hone in on what's going on in the US and how that impacts the sector. But I know you have that EMEA and Asia focus. So I wonder, when it comes to gold, if there are any trends that you're watching there right now that you think investors might be overlooking if they have that real US focus.
Yeah, thank you for pointing out that EMEA and Asia. That's just a legal wrinkle. Obviously, we cover the commodities globally. It's just a question of how we're remunerated and so on and so forth. China and India are the two biggest physical consumers. And if you put together jewelry and bar and coin, which are the accessible physical elements out there, then they vie between them for top spot. And between them, added together, they've got just over 50% of the market. Now, when we go back to actual price direction, we go back to what I was saying earlier about the big multiples in the professional market. So the professional market, if you like, is the speedboat, and the underlying fundamentals in terms of mine supply, recycling, jewelry, electronics, and so forth, and over-the-counter investment in private hands, that's more like the tanker, in the sense that it can take quite a long time to turn around. Now, if we have a very sharp price movement, what we do see, because we've got a big Asian operation in the bullion sector, we will see literally within 24 hours, we'll see metal coming out of places like Thailand, Laos, Vietnam, Cambodia, and so forth. And then they'll come back in again if the price drops. So it's quite a lively, active, well-mobilized market. China, we can come on to China and India because they're the behemoths. But generally speaking, as a rule of thumb, because you've got all this other stuff going on with the professionals, a strong physical market, and we need to talk about the official sector too in that context, because they're sort of the bridge between the two. A strong physical retail market will never of itself be enough to drive prices higher. But what it can do, particularly in anywhere from the Middle East eastwards, if you've got a sharp move in either direction, then the mobilization of that metal, because the jewelry is very high quality, low markup, so that can be mobilized quickly as well. It's not just bars and coins. That could put a bit of a damper on a move. It wouldn't necessarily cause it to turn around, but if the market dries up into a bull run, then you'll start to lose some momentum, and that will ultimately obviously become an element in price discovery activity, and vice versa if the price is dropping. As far as India's concerned, a tough time of it over the past 3-4 weeks or so. Because you couldn't get anything, or 4 months now, isn't it? No flights coming out of Dubai. So they had to turn to Southeast Asia for getting metal in, and they've managed to do that. But because everything was so difficult and insurance costs were high and freight costs and so on and so forth, so there was a little bit of a premium being built in just because the logistics teams have to make their living. The price technically went to a premium, but not for very long because everybody sort of stood back. So Indian demand's actually been pretty flat over the last month or so, which for the longer term is actually quite good news if you're a bull, because it means there's pent-up demand which will be waiting to come in when they can and when everything is sort of smoother. In China, the reduced economic activity, I think is probably the best way to put it, and the associated lack of consumer confidence means that big ticket items are out of the window, and the light vehicle market is down by 24% for the first 5 months of this year on a year-on-year comparison basis. So what that's done is that it's meant that although the Chinese jewelry market is, again, very high quality, it's 4 nines, what people have been tending to do over the last 6 months or so, they've been veering away from jewelry and going into bar and coin. So there is still quite a vibrant market, but the jewelers are struggling. So India's very quiet. China's not as lively as it could be, and the rest of the Far East churns it as much as anything else, but not the way a dealer would call churning. They're just sort of in and out on a regular basis.
Well, I think it's really good to take a look at what's going on in that part of the world, because certainly it plays a role in what's happening to gold. I want to go back to the price. I think people are wondering, we've gone below 4,000. I think you mentioned today we're back above it again. But how concerning, yeah, just a little bit. How concerning though is that fall below 4,000? Does it open the door for lower prices? And then I think people are also wondering, is there a particular trigger or catalyst that could lead us to higher prices down the line?
Question. This is where, as a fundamentalist, I have to take close note of what the technical analysts are saying, because I understand about moving averages and MACDs and a few odds and ends, but obviously the technicians are the ones who can see all the different nuances. And what we've got at the moment is a market that is, let me just pull up this chart and have a closer look so I actually get it right. Yeah, it's actually, in the shorter term, it's veering towards oversold. It's showing 34 on the relative strength index. Ideally, it should be about 50. But it's turning up ever so slightly. It's got a negative signal from the moving average coincidence and divergence. And then we've got overhead resistance at 41.81 from the 10-day, 42.72 from the 20. And the interesting thing here, and this could actually be the next leg down. You know the concept of the death cross?
Yes, but maybe we explain for people who might not know.
Right, I thought you probably would. It's applicable in any technical analysis, and it's the opposite of the golden cross. A death cross occurs when a shorter term moving average crosses below a longer one, and the golden cross is vice versa. And the one that is generally used in the gold market is the 50-day and the 200. And as I speak, the 200 is 44.69.44, and the 50, which is trending downwards, is 44.84. So there's only $10 in it. So if the 50 crosses the 200, and it would need to cross it by maybe 2% or so for confirmation. So it's not as if we turn the lights out when we leave the office this afternoon. But that is a potential another downward leg, and that would explain, I would think, why some specs are hanging back, because they want to see what happens. Because there is an argument, which I don't believe, frankly, that technical analysis is self-fulfilling. Something like this, it probably can be in the shorter term, but most technicians will take differing views from each other. It's not a question of all hitting the drum to the same beat.
Yeah, I always find it really interesting. Different technical analysts they look at the same charts and come up with a different interpretation. So always interesting to look at.
I was just going to say, I used to, in a different company, I used to sit next to a chap who was a technical analyst, and he worked predominantly in Elliott wave theory, and he was right 9 times out of 10. It was very impressive.
Wow, that is an impressive degree of accuracy. All right. Yeah. So we've got some idea of what could be coming for gold, and I know we're running out of time. I'm going to throw in one question before I let you go on silver. So yes. How do you see the outlook for silver panning out into 2026? I know it's got its precious side and its industrial side, which means it could follow gold, or maybe it follows, if there's negative global economic projections, could follow that way. So what do you see for silver?
Yeah. I've actually done work on that. I've looked at the 4 different recessionary periods that we've had in the States since 1990. And with one very small exception in the second recessionary period, which I think was the shorter one, both in terms of correlation and direction of travel, in those recessionary periods, silver has behaved much more like copper than it has gold. So that's when you're in recession, that's when it starts sulking, because its industrial side is being hit. For the much longer term, we've got the advent of AI, obviously, which means much heavier precious metals loading on the chips. We've got the electrification of the vehicle fleet, which, as I think most analysts were expecting, is not going according to plan. And we've got solar cells, which are currently oversupplied. But those three, if you take a sort of 5-year view, or if you're a mining company, you need to take a 10-year view. Because I used to work at one, and that's how we did it. Its future is bright, but only 21% of silver supply is actually price elastic. And most of what comes out of the ground, I'm including industrial scrap there, but most mine production is going to be a function of the business models for copper, for lead, for zinc, or for gold. It's not silver. So what we're going to get, unless the base metals boys, my colleague Natalie can tell you much better than I can, unless the base metals industries are expanding in a hurry, and from what I pick up, they're not, there is going to be a substantial shortage of silver, which means you're going to see higher prices in order to rebalance the markets.
I think I've heard the same thing about what's going on in the base metals industry. I don't think that expansion is coming as quickly as we might want to see it. Okay,
Exactly.
so yeah, a little bit of information on the path forward for silver too. I'll let us wrap it up there. I know I've got to let you go, but thank you so much for coming on to explain what's going on in gold and silver. This was great.
Anytime. I enjoyed it. Thank you for having me.
Of course, yes. We'll have you back soon. Maybe we get to the PGMs next time. But for now, once again,
I love the PGMs. They're a great story in both directions.
Yeah. Okay, we'll have you back for that one for sure. For now, I'm Charlotte McLeod with investingnews.com, and this is Rhona O'Connell with StoneX.
Thank you for watching. If you like this video, make sure you hit the like button and subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below.